Let's get into the multifamily construction space. And I want to show you the first chart here, which goes back several decades and gives you a good sense of what has been happening with multifamily construction back before the great financial crisis. And I think this is really important to take a look at. As you can see from, the mid 90s through the financial crisis till about 2008, 2009, the number of housing units that were being built, and this chart shows specifically housing units in buildings that have 5 or more units. That's the definition of multifamily, just so you know. Anything that's 4 units or below is considered residential. Anything that's 5 units and above is considered commercial and is quote unquote multifamily. So if you look at multifamily starts, and if you're not familiar with that data set, basically it's just how many new multifamily units go under construction in any given year. It was averaging right around 300,000 from the mid 90s through the financial crisis. But as you can see here, it absolutely tanked from about 2008 to 2010, 2011, where it dropped below 100,000 units. So less than a third of what it was during normal times. And although it bottomed out around 2010 or maybe 2011, something like that, as you can see from this chart, it took quite a long time for this to recover. And it wasn't until about mid 2016, 2017, that we actually surpassed what was going on pre-recession and started to make up some ground. And this is really important because what happened was that we lost several years of multifamily construction. And although we sort of started building more over the last couple of years, there was, for a while, this idea that we had to compensate a lot for those couple of years when we weren't building as much. If you're familiar, there's a similar chart just like this that shows residential properties, and that is even way more dramatic. It took way longer for construction to recover. In the multifamily space, it actually recovered quicker. It only took a couple years, like 5 or 6 years to recover. And that's going to be really important in our conversation today. So I just wanted to call that out. Last thing on this chart that you should take note of is just how much multifamily construction has exploded over the last couple of years. Starting around the pandemic, it went up from where it was averaging somewhere around 400,000 units to now somewhere around 550. We've even touched 600,000 units in a couple of different months. So this is record high levels of multifamily construction that we're seeing over the last couple of years. Now, you might be curious, is this sustainable and is this going to continue? And normally, forecasting is really hard. And when you try and predict prices or inventory or the price of a stock or anything like that, any of that forecasting is really difficult. Forecasting construction is actually a little bit easier because we know what's in the pipeline, right? People have to apply for permits before they even start construction. They have to do construction for a couple of years before they deliver those units. As analysts, we actually know what is in the pipeline. And I'll show you the second chart and you can see the total number of deliveries. That's the orange bar, shows you the total number of units that are expected to actually come online on the market over the next couple of years. Now you can see there's like a dotted line going up and down there. That's where we go from actuals to a forecast. And so you can see that the actuals, just even, over the last couple of years have been creeping up. But when you look at the forecast into 2023 and into 2024, you can see that the number of deliveries, again, that's the number of multifamily units that are coming on the market, are higher than they were in any quarter consistently, right? Like we've had one-offs where we've had that many, like Q3 of 2022, but look how consistently high the number of deliveries are over the course of the next 2 years. So if we just combine these two charts and what they're telling us, it's that for the last several years, we've had more construction starts than we have in many years. And now we have more construction deliveries forecast for the next 2 years. So if there is a lot of demand and like a lot of new households are forming and more people just like the total number of people in the US who want apartments was going up, this would probably be a good thing. But this is happening, at least to me, at a concerning time because absorption, which I'll explain in a minute, but absorption turned negative for multifamily in Q4 of 2022. So take a look at this. This is a super important chart for really understanding supply and demand in the rental markets and just rental property investing, specifically in multifamily though. So on this chart, we have two things going on here. Well, we have three things going on. The first blue lines, that's net deliveries. Remember, we just looked at a different chart that shows this. As you can see, into 2023 and 2024, those are looking higher than they have ever been. The orange bar, which is absorption, measures the amount of demand. And so in a perfectly balanced market, the blue bar and the orange bar would be even, right? The amount of units that were coming on were equal to the amount of people who want those units. But what's actually happening is nothing like that. We're actually seeing absorption, which is another way of measuring demand for rental properties from the tenants, not from buyers. From people who want to lease a a multifamily unit is really low. And you can see that the absorption is far below deliveries, meaning that for the next several years, according to CoStar, where I get this data, and it is pretty reliable, it is saying that there are going to be far more multifamily units delivered to the market than people who want those. And as you can see, the result of this, if you're thinking, so what? Why does this matter? Check out this green line. This chart is really good. It shows a lot of things in one chart. The green line shows vacancy. And as you can see, CoStar, because of this imbalance between supply and demand, is forecasting that vacancy is going to go up above 8%. In 2024, it will start coming back down, as you can see, when the absorption delivery ratio gets a little bit better. But this is a big change, right? Like, look at where vacancy was in 2021. It was, at 4.5%, 5%. Right now, we're sitting around 6.5%, but it's going to go up considerably. And that obviously negatively impacts revenue and cash flow for multifamily investors. Why is this all happening? Of course, there has been a lot of demand for apartments over the last couple of years, but to me, I believe that because of potential recession, because of the economic slowdown, these high-profile layoffs that are going on, a lot of people who might be going out and starting a household are not going to do that. And if you've never heard of this term, household formation, it basically means, say you have one roommate and you both go out and lease your own one bedroom instead of living together. That creates an extra household, right? You were living in one household, now you're two households. This can happen if you move out of a family member's house or a bunch of roommates split up. And during the pandemic, household formation was going crazy, but it has started to come down. And this can happen even though population is growing. Household formation is really what drives demand for rental properties from the tenant perspective. And CoStar, again, where I got this data from, had a really good, line in their report that I want to just read to you that sort of summarizes it really well. And I quote, "The tempering of demand can be tied to rising inflation cutting into potential renter households' budgets. Furthermore, concerns regarding the nation going into a possible recession, without a doubt, has put a hold on many potential household formations. The moderating absorption conversely hit at an inappropriate time, as 435,000 new units were delivered during the quarter. The resulting supply-demand imbalance pushed the vacancy rate up to 6.6%. This is from last quarter. But as we can see, this underlying dynamics about supply and demand are about to get worse. And so I personally believe the vacancy rate is going to continue to go up. And if you look at this last chart here from from CoStar, you can see an interesting dynamic. And that's that higher quality properties, CoStar ranks their properties by star level. So 4 and 5 star properties are like A minus properties. Those are forecast to have the highest vacancy rates. And that's probably because that's what's getting built in the US, right? That's where the oversupply is coming. But if you look at 3 stars, which is more of like a B or maybe a C class unit, those vacancy rates are expected to go up from where they are now, but they're not expected to get as high as those 4 or 5 star rates. 4 or 5 star rates are getting up above 11%, whereas the US national average is expected to be somewhere between 7 and 8.5%. So what we're seeing is that vacancy already is highest for luxury properties, and that is likely going to continue, at least on a national level. But what we all know is that the housing market is local. So the question now becomes, which markets are at the biggest risk of overbuilding? And there's no set way to do this. So I came up with my own methodology for making this evaluation. Everyone can do this their own way, but basically what I decided to look at was a few things. First, I looked at how many units are under construction, the total number of units under construction. Then I looked at how that number of total units under construction compare to current inventory level. So basically that measures what percentage of the total number of units in a given area are under construction right now. Because if that number is really high, that suggests that as a percentage, that market is adding a lot of supply. If that number is low, that means as a percentage of the total number of units, the new stuff is relatively low and it probably won't make that big a difference. I also looked at net absorption, which we talked about a little bit. What that basically is a measure of supply and demand. So I looked at that. And then I also looked at net absorption as a percentage of inventory. So if net absorption is negative, how negative is it compared to the total number of units on the market? So those are the things I looked at, but let's get into this. I'm going to give you my top 5 markets that have the highest risk of overbuilding in the U.S. Number 1 is Santa Fe, New Mexico. Santa Fe, New Mexico has a net absorption of negative 1,100, roughly. I'm going to round on these numbers here. So basically what that means is that over the next 2 years, CoStar is expecting that there will be 1,100 more units than there are people to rent out those units. 1,100 is not crazy, but given the size of Santa Fe, which is kind of a small city, it's big in proportion to the total amount of inventory. That's actually 17% of its inventory might not be occupied. And to me, that's why Santa Fe is the number 1 city. Number 2 is Punta Gorda, Florida. And in this market, it's pretty amazing. But unit growth, the total number of multifamily units available, is expected to grow by 48% in the next 2 years, which is by far the biggest of any city I analyzed. And the reason this is so significant is that those units are coming online at a time when net absorption has already turned negative. So that means supply is already outpacing demand, but they're expecting to get almost 50% more units in the next 2 years. To me, that is pretty risky, and there's a severe risk of being overbuilt. Number 3 is Myrtle Beach, South Carolina. Again, this is another city where inventory is expected to grow a lot, 22% in just 2 years. And that's obviously less than Punta Gorda, but that is not normal. You don't normally see multifamily units going up by 22% in 2 years. That's crazy. In Myrtle Beach, inventory is expected to outpace demand by a considerable amount, by 1,900 units in the next 2 years. And that's about 10% of their inventory. So I would be concerned again about Myrtle Beach, South Carolina. Number 4 on our list is Colorado Springs, Colorado. These numbers get a little bit more reasonable. So the first 3 on the list are I think a little bit more extreme. Colorado Springs, though, is still at risk of being overbuilt. They have a net absorption of negative 3,300 units, which is 6% of their inventory. So it's under the, 10%, which is a lot better, but it's still pretty considerable when you're thinking about the fact that 3,300 units are going to get built that probably won't have corresponding demand. Number 5 on our list is Austin, Texas. And, I've sort of been beating up on Austin. I actually like Austin, but I do think it has grown too quickly and that it is one of the markets that is going to see one of the most severe corrections. We talked about that on a recent YouTube video where I did a deep dive into Austin. And I think that is true on a residential level. But when you look at Austin with their commercial pipeline, it is enormous. Their net absorption is supposed to be negative 16,000 units. That's right. Over the next 2 years, even though Austin has growing demand, the number of units expected to be delivered is over 35,000, and only 19,000 new households are expected to be created, leaving a net absorption of negative 16,000. And I know Austin is booming, population is exploding, there are good jobs there, but it is difficult for a rental market to handle 16,000 new units without corresponding demand, without vacancy going up and rents potentially falling. So those are my top 5 markets at the biggest risk of being overbuilt. But of course, there are also markets that are doing pretty well. And I'll just name 5 of them for you. Some of the ones that I like are Missoula, Montana, Athens, Georgia, Midland, Texas, Provo, Utah, and Topeka, Kansas. The reason I like these markets is that they all have positive net absorption forecasting, again, meaning that demand is likely to outpace supply over the next couple of years. That's why I think that they're pretty good and they're not at a huge risk. And I just think it's interesting when I was looking through this list that the cities that are doing well tend to be smaller, right? Like Missoula, Athens, Georgia, Midland, Texas. They're a lot smaller than Austin, Colorado Springs, Myrtle Beach. Like those are pretty big markets. Just after eyeballing it, you can see that these big cities are at a bigger risk of overbuilding, just generally speaking. Obviously, there's some big cities that are fine and some small cities that aren't doing well, but that was just a pattern that I noticed. In conclusion, multifamily is at risk of being overbuilt on a national level for the time being. That's just for now, though. Just keep that in mind, that demand will likely pick up again when the economic picture improves. And that is based on demographics, right? If you look at long-term demographic trends, supply trends, specifically in the single family space, the fact that there aren't a lot of single families or other options for people who want to rent, that supports the idea that there is good long-term support for demand for multifamily units. It's just not looking that great in the short run, to be perfectly honest. What I recommend is if you are a multifamily investor or really investor of any type, check out this data, because even if you're not in multifamily, supply and demand dynamics that are going on in these big buildings could impact your area and your rents and your property's performance. So check out construction trends. You can find this on the FRED website. It's super easy to find. Just Google it or go to FRED. It's the Federal Reserve Bank of St. Louis. They have a great website that shows you construction permits, starts, and completions. You should also check out net absorption for your area. You can just Google that. That would give you a really good understanding of the direction of multifamily rents, vacancy, prices in the next couple of years. So hopefully this has been helpful to you. This is a new topic that we haven't really talked about a lot on this channel, so I would love your feedback on whether or not this was useful to you. You can let me know in the comments below, or again on Instagram, where I'm at The Data Deli. Thank you all so much for watching. I'll see you next week.